In today's world, securing our financial future is more crucial than ever. Gone are the days of relying solely on traditional savings accounts with minimal returns. Investing offers a path towards building wealth, achieving financial goals, and securing a comfortable future. This journey might seem daunting, especially for beginners. Understanding different investment options is the first step to making informed decisions. This exploration will break down popular investment avenues like stocks, real estate, bonds, and more. By demystifying these options, we aim to empower you with the knowledge to embark on your investment journey with confidence. Whether you're aiming for long-term growth or seeking to generate passive income, there's an investment strategy out there for you. Let's dive in and explore the dynamic world of investing. Investing is simply putting your money to work for you. Instead of letting your savings sit idle, you use them to potentially grow in value over time. Think of it like planting a seed. With time, care, and a bit of luck, it can flourish into a fruitful tree. Investing is crucial for several reasons. Firstly, it helps combat inflation, which erodes the purchasing power of your money over time. Secondly, it allows you to build wealth, reaching financial goals like buying a house, funding your retirement, or securing your children's education. But it's important to remember that investing involves risks. The value of your investments can go up or down, and there's always a possibility of losing money. Understanding your risk tolerance and investing wisely is key.
When you buy a stock, you're essentially buying a tiny piece of ownership in a company known as a share. This means you have a claim, however small, on the company's assets and earnings. These shares are traded on stock exchanges, and their prices fluctuate based on various factors, including the company's performance, industry trends, and overall market sentiment. The stock market is a dynamic environment where prices can change rapidly, influenced by news, economic indicators, and investor behavior. Investing in stocks can be lucrative. Over time, many investors have seen significant returns on their investments, especially if they choose companies that grow and prosper. If the company performs well, its stock price tends to rise, allowing you to sell your shares for a profit. This capital appreciation is one of the main ways investors make money in the stock market. Additionally, some companies pay dividends, a portion of their profits distributed among shareholders. Dividends can provide a steady income stream, which can be particularly attractive for long-term investors. However, stocks come with risks. The value of your investment can go down as well as up. Their prices can be volatile, influenced by factors beyond your control. Economic downturns, political instability, and changes in market sentiment can all impact stock prices. If a company underperforms or the market experiences a downturn, your investment could lose value. It's important to be prepared for these fluctuations and not to panic during market dips. Remember, investing in stocks requires careful research and a long-term perspective. It's crucial to understand the companies you're investing in and to diversify your portfolio to spread risk. It's not a get-rich-quick scheme, but a strategic approach to building wealth over time. Patience and discipline are key, as the stock market rewards those who stay invested for the long haul.
Section 4, Building Wealth with Bricks and Mortar. Real estate investing. Real estate investing involves buying, holding, selling, or renting properties for profit. It's a tangible asset class that has historically been a popular choice for investors seeking both income and long-term appreciation. One way to invest in real estate is by purchasing rental properties. As a landlord, you collect rent from tenants, generating a steady stream of passive income. Additionally, property values tend to appreciate over time, potentially increasing your net worth. Another avenue is flipping houses, which involves buying undervalued properties, renovating them, and selling them at a higher price. While potentially profitable, flipping requires expertise, capital, and a tolerance for risk. The process of flipping houses can be thrilling but also demanding, as it involves a keen eye for potential, a knack for negotiation, and the ability to manage renovation projects efficiently. Real estate, while generally considered less volatile than stocks, has its own set of risks. Property values can fluctuate due to economic conditions, market trends, and even changes in the neighborhood. Tenants can be unpredictable, sometimes causing damage or failing to pay rent on time, which can disrupt your income flow. Unexpected repairs, such as fixing a leaky roof or replacing an HVAC system, can eat into your profits and require immediate attention. Thorough research, careful planning, and a solid understanding of the local market are essential for success in real estate investing. It's important to stay informed about market trends, property values, and economic indicators that can affect your investments. Networking with other real estate professionals, such as agents, contractors, and property managers, can provide valuable insights and support. In addition to traditional methods, there are also modern approaches to real estate investing, such as real estate investment trusts, REITs, and crowdfunding platforms, which allow you to invest in real estate without directly owning property. These options can offer diversification and lower entry costs, making real estate investing accessible to a broader range of investors. Whether you choose to be a hands-on landlord or prefer a more passive approach, real estate investing can be a powerful tool for building wealth and achieving financial goals.
Section 5, exploring bonds, lending for returns. Bonds are like loans you give to governments or corporations. When you buy a bond, you're essentially lending money to the issuer for a fixed period at a predetermined interest rate. Bonds are considered less risky than stocks. They offer a predictable stream of income through regular interest payments, known as coupon payments. At the bond's maturity date, you receive your principal back. However, bonds generally offer lower returns compared to stocks. Their value can also fluctuate based on interest rate changes. When interest rates rise, bond prices tend to fall, and vice versa. Despite their lower potential for growth, bonds play a crucial role in a diversified investment portfolio, providing stability and reducing overall risk. Section 6. Mutual funds and ETFs. Diversifying your portfolio. Mutual funds and exchange-traded funds, ETFs, are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of assets, such as stocks, bonds, or real estate. These funds are designed to provide investors with a broad exposure to various asset classes, reducing the risk associated with investing in a single asset. These funds offer instant diversification, spreading your risk across various assets. They are managed by professional fund managers who make investment decisions on your behalf. This professional management can be particularly beneficial for those who may not have the time or expertise to manage their own investments. Mutual funds and ETFs come in various flavors, catering to different investment goals and risk tolerances. Whether you're looking for growth, income, or a balanced approach, there is likely a fund that matches your needs. Some funds focus on specific sectors or industries, such as technology, healthcare, or energy, allowing you to target areas of the market you believe will perform well. Others track broad market indices, providing a more general exposure to the overall market. While these funds offer convenience and diversification, they do come with management fees. These fees can vary significantly between funds, so it's important to understand what you're paying for. It's essential to compare expense ratios and carefully select funds aligned with your investment objectives. Lower expense ratios can help improve your overall returns, especially over the long term. By investing in mutual funds, or ETFs, you can participate in the financial markets without needing to pick individual stocks or bonds, making it suitable for both beginner and experienced investors. This approach allows you to benefit from the expertise of professional fund managers and the inherent diversification of these investment vehicles, potentially leading to more stable and consistent returns over time.
Section 7, the cryptocurrency craze, a high-risk, high-reward venture. Cryptocurrencies like Bitcoin and Ethereum have taken the world by storm. These digital currencies operate independently of central banks and governments, relying on blockchain technology for security and transparency. Cryptocurrency investments have the potential for massive returns. Their decentralized nature and limited supply have fueled speculative trading, leading to significant price swings. However, cryptocurrencies are highly volatile and speculative. Their value is driven by market sentiment, regulatory news, and technological advancements, making them a risky investment proposition. Investing in cryptocurrencies requires a high risk tolerance and a thorough understanding of the underlying technology and market dynamics. It's crucial to conduct thorough research and invest only what you can afford to lose.
Thank you for watching, and be sure to subscribe and hit the notification button to see all our latest videos.
Feel the day is brand new, every step we take, every dream comes true.